All right, so now we're going to look at section 5.2, and we're going to take the rules that we discussed in section 5.1 and apply them by analyzing the transactions. So we're going to use the same kind of, I don't know what it is, 6-step, I guess, process to analyze the transactions affecting revenue, expenses, and withdrawals, and put the transactions into the proper debit and credit entries on your T accounts. So the first transaction here is the 15th. We provided delivery services for Sims Corporation. A check for $1,200 was received in full payment. So that's a revenue transaction, right? That's how we do our business. That's how we make our money. So we know that receiving a check is cash. Cash is an asset. It increases on the debit side. So we're going to debit cash, and the credit is going to be to our revenue account, whatever that might be. Looks like if you look down here, our revenue account is called delivery revenue. So it's kind of cool. You can think about a revenue transaction like this. You can say it's always going to be a credit to revenue, and the debit's going to either be to cash or to accounts receivable. So we either did our revenue for cash or we did it on account. So basically, those are the only two types of revenue transactions you can have, if that helps. Okay, transaction 9, we mailed a check. So we wrote a check for $700 to pay rent. Obviously, this is an expense of doing business. Rent expense is an expense account. So now we're going to classify them in those other areas. Cash is obviously an asset. We know if we write a check, we're going to credit cash. What's the debit going to be to? An expense is almost always a debit. So an expense decreases capital. What is a decrease to capital? It's a debit. So if you want to think about expenses, it's always going to be a debit, and you don't generally pay for an expense with a credit transaction. So it's pretty much always going to be to cash, but we'll have a few examples that might change that a little bit. Let's see. So here in our 10th transaction, we prepared an advertisement. So very similar to the last one. It's an expense. They're going to classify it as advertising expense. And they're going to agree to pay later. So here's where we're going to have an expense with a liability. Whenever we say we're going to pay later, that's going to be a payable, not a receivable. So our two accounts are going to be an expense and a liability. We know that we increase a liability on the credit side, and expense is always a debit on the left side. So the debit is to advertising expense, the credit to the payable. So here's these two examples. Both debits are the expense, and in one case we're using cash, and the other case we're doing a liability. Okay, another little pause. Our 11th transaction is we build city news for delivery service. So again, this is our way of making revenue, or doing revenue. So we build them, meaning we didn't take cash in. So we're going to have a receivable, a future value. And revenue we know is going to be a credit, because that's its increased side, and the debit's going to be to accounts receivable. So that's the other example that I told you about. The two types of revenue are going to be always a credit to revenue, and then the debit is going to either be to cash or a accounts receivable account of some sort. That brings up, I feel like, the only vocab word, no, there's a couple others, of the chapter, something called revenue recognition. And it is a GAAP principle, so generally accepted accounting principle, that states that revenue is recorded on the date that it's earned, even though we haven't really received it, because this is a receivable. But everyone recognizes this principle the same way. So whenever you do the service, that's when you record the revenue, even though we don't really even have the cash yet. Okay, so this is kind of a duplication of what we saw before. We had a utilities expense and we wrote a check. So we're going to have a debit to expense and a credit to cash. Another expense here, we wrote a check to have the office repainted. They're going to classify this as a maintenance expense. That's one thing interesting about expenses is we'll have examples that'll have 6 or 7 different types of expenses, and then you have to classify what you think it falls under. But again, the debit is to expense and the credit is to cash because we wrote a check. And then our last one here is for the withdrawal. So she wrote a check to withdraw $500 cash for personal use. So very similar to an expense. The transaction is, but the concept isn't because it's not an expense of doing business. She didn't have to take out money. So we really we're going to look at that in our financial reports differently. So the account is called the owner's name, withdrawals. And since we wrote a check, obviously we have cash. Withdrawals is something that decreases capital. So it is going to be a debit. It's a normal debit balance. And writing a check, we know, is a credit to cash. So after all that happens, we, like we've been doing in our Excel spreadsheet, we've been proving that the debits are equal to the credits. And eventually this becomes a financial report. But in the meantime, we're going to do something like the report listed here. And eventually we're going to call it a trial balance. But we're going to take our chart of accounts and we're going to list every single account with their account number. We're going to list whether it has a debit balance or a credit balance. And then we're going to total all the way down the debit balances and total all the way down the credit balances. And hopefully, keeping our fingers crossed, they are the same. Okay, that's it for section 5.2.